3 weeks ago, I published a video explaining the 5 signals we saw that prompted us to shift to cash and get out of the market right before the NASDAQ fell 8.5%. But now we're back in the market with 3 open positions showing gains of 24%, 14%, and 12%. So in this video, I'm going to show you exactly how that happened, because on April 8th, our rule-based market timing model flashed a specific buy signal and we acted on it immediately. So we're going to show you what that buy signal looked like, exactly what we bought, how we properly sized those positions, and where things stand right now. No predictions, no opinions, just the methodology doing what it's designed to do. So let's go ahead and take a look at what the charts are showing us. Here's where we left off. In our community, when we're all 100% in cash, we call this SOH mode, sitting on hands. It means our capital is protected, we're not forcing trades, and we're waiting patiently for the next buy signal, because no market goes down forever, just like no market goes straight up forever. SOH mode, sitting on hands, is not a failure. It's a discipline. Now, after that video was published with the market near the lows, we were patient. We simply waited for the buy signal to come, and the buy signal came on April 8th. And when it did, we moved fast. So in a minute, I'm going to show you exactly what we did and why. But before I do that, I want to talk about 2 traps that commonly occur when a market is in a correction mode and trying to come out of a correction. Now, if a trader sells near the lows, they obviously sustain a loss, but they actually typically get hurt 2 times. They get hurt not only on the way out, but also trying to get back in. There's 2 different traps that we see. One trap that's common is people try to pick the bottom. Well, trying to pick the bottom when a market is in a downtrend is like trying to catch a falling knife. And the problem is that every little bounce after a big decline, it looks like the bottom. So traders often buy that first bounce, then they stop out, then they try again. And the market chops around at the lows. They often bleed small losses and they lose their confidence. So by the time the real move higher starts to go back up, they've been wrong so many times that they don't trust the next signal. And trying to pick the bottom costs you twice, because once in your losses, but once in your confidence. Because by the time the real move starts, you don't trust it. Now, the other trap that I see a lot of traders get stuck with is waiting for a pullback that never comes. Because more disciplined traders, they don't pick the bottom, they wait for price confirmation. But sometimes what happens is you get a V-shaped recovery. And as you can see here, after the NASDAQ formed its low, it went up for 6 straight days in a row. So traders that were waiting for a pullback kept waiting for a better entry price that never came. So they protected their capital on the way down, but they missed the recovery on the way up. Remember, the market does not owe you a better entry. It just keeps going. And both of these traps have the same root cause: no rule-based signal telling you exactly when the odds have shifted. And without that signal, you're either guessing too early and getting chopped around near the bottom, or you're waiting too long and watching the market rally without you. There's no in between if you don't have a rule-based strategy. So we were not smarter than those other traders that sat on the sidelines and watched the market go back up. We simply had a signal because of our rule-based methodology. We never try to catch the top, nor do we try to catch the bottoms. Our goal is to catch the bulk of the move out of the middle when the odds are in our favor and we've got a profitable edge. That's what swing trading is designed to do. So what actually changed on April 8th? What was that one signal? We're going to look at that, and I want to show you exactly what it looked like on this chart, because it's the thing that most traders were waiting for without even knowing what they were looking for. So what exactly was so significant about April 8th that prompted us to get back in the market? Well, there was 2 key signals. The biggest signal was we got an IBD follow-through day. A follow-through day is when the index rises at least 1.25% on higher volume than the day before, at least 4 days after the market has formed a low. This happened on day 6. Notice how the volume that day surged above the prior day's high, and we had a gain of over 2%. So we got a follow-through day, which is a very reliable signal that institutions, banks, mutual funds, hedge funds, pension funds, the big money starting to step back into the market. That's why that follow-through day signal is so key. Now, the other thing that we saw was that we got a gap up back above the 50-day moving average. That's this red line. Now, the 50-day moving average is really significant because that's a line in the sand for intermediate term trend. Typically, in an uptrend, that 50-day moving average will act as support. And when the market starts to roll over, it acts as resistance. But we gapped up above that 50-day moving average, and we held it, not only in the NASDAQ, but the S&P as well. So we had two clean technical signals there. We had the IBD follow-through day combined with the price action getting above the 50-day moving average. Now, the key point I want to make here is that we were not trying to predict that the bottom was in. Instead, we were simply reacting to what the chart was telling us. That's the difference. That's always the difference. We don't predict price action. We react to what the chart's showing us. That's why our mantra is trade what you see, not what you think. Now, two things on April 8th, two things would have told us thereafter it's time to step back. And that is that if we got a distribution day within a few days after that buy signal, let's say the market sold off in higher volume than the prior day, we got a distribution day, or if the market closed back below of this low of this April 8th gap up without a quick reversal back up. So in other words, if that gap up failed the next day or within the next day or two, that would have invalidated our buy signal. But neither of those things happened. And in fact, let's take a look at what did happen after our buy signal. As you can see, after our buy signal, the NASDAQ continued higher, and we've been marching steadily higher since then. All right, so what exactly did we buy when the market gave us this buy signal? Well, first of all, it's important to realize that we did not jump in and buy 10 positions at once. We started with just a few, and we told ourselves, let's see if the price action stays healthy. And if it does, we'll add more positions. But if we see a distribution day or the price closes back below the gap day low, then we're going to reassess. So the plan was in place before we even placed a single order. So let's look at the individual stocks that we got in. On April 9th, we bought Micron, MU. And this is what MU looked like on April 9th when we entered. You can see right here, the price had gapped above the 50-day moving average and was holding at support there. So the price reclaimed it after getting hammered during the correction, and that was our setup. Now, this Micron was not the strongest stock in the market, but it's a quality name at a key level with real buying behind it and a relatively high risk-reward ratio with the convergence of the 20 and the 8 EMA just below as support. Celestica, CLS, this was one that we entered via intraday trade alert to our members. And this is what the chart looked like when we spotted it. It had a downtrend line that had been holding the price back for months, actually. And on April 9th, the price broke out through it on a strong monthly chart. So we sent the alert to our members in real time, and we entered at 321.98 right here. That same day, we also entered Intuitive Machines, LUNR. Again, we got in with a similar intraday alert trigger the same day, and the alert went out and our members got in. And this is why we supplement the pre-market report with intraday alerts, because setups don't always wait for the open. Now, fast forwarding a few days later, we then bought GLW, Corning, on April 16th at 164.50. Now, GLW was actually on our watch list back on April 9th, but it never pulled back to our buy price, and we don't chase. So we canceled the limit order and we waited. And then on April 16th, it set up again. So an intraday alert went out and we got in at 164.50. So the stock came to us on our terms, and that's key. We didn't chase it. Now, a key point here is that before I placed a single order in any of these stocks, I knew exactly how much I was risking. And that number was determined by the chart, not by how I felt about the trade or how much conviction I had. The chart tells me my position size. Now, we did have two trades that did not work out. ARM was one of them. On ARM, we entered on April 10th, and that same day it stopped out, and we got a 4.3% loss on the stock. And the other stock that didn't work out was PL. We entered PL on April 13th, but it stopped out the next day on April 14th, and we had a 6% loss on that stock. Now, most traders look at these numbers, a 4% loss and a 6% loss in the stock, and they feel sick. But here's the full picture. Both of those trades were intentionally sized so that the maximum loss to our trading account was less than 1/4%, 0.25%. Not 4%, not 6%, but 1/4%. That's position sizing working exactly as it was designed to do. Our rule was hit and we exited. No second guessing, no hoping for a bounce. Our stop was hit, the exit was taken, and we're done. Move on to the next trade. You cannot hold winners with conviction if you're not willing to cut losers without hesitation. The two are connected, and that's the methodology. Now let's fast forward to the current day and see where these stocks that we bought currently stand. Here you can see CLS that we entered at 321.98, And as of Friday's close, we're currently sitting on a gain of 23% since our entry about a week ago. It's still open. We did trim a partial position to take some profits at a 21% gain on April 14th, just to lock in some profit. But the core position, 80% of our position is still running with a 23% gain. Micron MU, we entered at 405, and that's currently up 12.4% from our entry. Still open, and we're looking for a potential breakout to a new high. And LUNR, we entered at $24.20, and this is currently up 14% from our entry at a new high, and it's still open. Now, this is also a key part of the strategy is we don't try to guess where these are going to run out of gas and form a top, especially when they're breaking out to new highs because there's no overhead resistance. So instead, we look at what the chart's telling us. When the chart tells us it's time to reduce or to exit, that's when we act, not before, but when the chart tells us. So Wagner Daily subscribers will be notified by Trade Alert when we identify the ideal exit point on each of these positions, because every entry and exit, we send trade alerts in real time. Now, our total exposure in our model portfolio is only 17% right now, which means we're still 83% in cash. Like I said, we ease back into the market. We selectively deployed some capital, but we're not all in. Again, only 17% of our capital is currently deployed. And the other thing I want you to realize too is that I mentioned earlier, we don't pick bottoms. Notice that the market was already 5% off the lows when the NASDAQ gave us the signal to get back in the market. So we did not catch the exact bottom, and we didn't try to. But what we did do is we caught the bulk of the move out of the middle when the odds are in our favor. And that's exactly what our rule-based methodology is designed to do. The position sizing formula that kept those two losing trades to less than 0.25% each, I walk you through that step by step in a free live masterclass. Also, the buy signal that got us back in the market on April 8th, I cover that too. In fact, I cover the complete methodology, connecting all the pieces together in the right order. That's what this live masterclass is about. And if today's video showed you anything, it's that a rule-based methodology works. The question is whether or not you have one. The next session date and registration link are in the description below. It's free, it's 90 minutes, and if today clicked with you, I guarantee it'll be worth every minute. And if you missed that video that started this story, the 5 signals that got us out before the NASDAQ fell 8.5%, I'll leave that video for you here too. So check it out. See you in the next video, and remember to always trade what you see, not what you think.